All right, so gold and silver prices are weaker right now. Today, they're trying to bounce back up a little bit, but generally, you can say that gold and silver prices are looking a little bit weak over the last few days and weeks. Now, will that be a long term issue? And I've been adamant in saying that no, it will not. And I've talked about some of the catalysts to kind of turn things around, one being Delta, which is probably the main catalyst. We're also in a time with rough seasonality, but what other metrics can we take a look at to help us out in being really sure of our view? So yesterday I made a video about the bond market, and if we take a look at what happened a couple of days ago, the U.S. 10-year Treasury yield has really been on the move to the upside. Take a look at this graph here. Basically, as you can see, at the beginning of August, we hit a bottom, and then we started rising, trading in a range, and then start of last week, we really start to take off. And now there's a lot of risk on appetite that we're starting to see within the bond market, which is a leading indicator of things to come. It is a foretaste of the feast to come. Some of you may know what that reference is. So, US oil is a commodity, and you can also view value chains. If you take a look at different parts of the value chain, you can look at them as leading indicators as well. So, we've already talked about the bond market, but let's talk about value chains as being a leading indicator. And as you can see here, for a while, the oil price has really been making a move to the upside. And pretty much, let's actually see if I can scroll down here a little bit more. Since the end of August, we've been seeing oil prices rise, kind of, came down a little bit. And then over the course of the last several days, along with the US 10-year Treasury note yield, they have been rising as well, getting close to overbought territory here with oil. So oil prices are moving up. And commodities, which oil would be, is pretty much at the start of the value chain. And as you go further down the value chain, you just tack on additional price increases. So let's say oil is one of those raw commodities. The next thing that you could then say is, well, what will come after that? Well, there are a lot of different manufacturers that use oil. And you could say, well, hey, Boeing is another one of those manufacturers that use oil. But it also looks like they're engaging in business investment of durable goods. So within the manufacturing sector, which is the next chain in the value chain, they've been buying up durable goods. Now, you may say, well, what does durable goods have to do with anything? Well, the thing about durable goods is that if a company is investing in them, they know that, or they feel pretty confident that they can get rid of or they can sell whatever it is that they're trying to make, that there's demand for it. They're not just going to buy a bunch of durable goods, heavy goods, and not feel confident in saying that, we can sell these things like hotcakes. So if you go down here, you can actually see how MarketWatch is basically looking at this at the big picture section. The manufacturing side of the economy is not as big as it once was, as we know, but it still plays a big role in how fast the U.S. expands and is an important bellwether, as I mentioned. The good news is that manufacturers still have plenty of demand, a sign of a healthy economy. Now, you may look at our current economy and say, well, how's it healthy? Well, I've given you plenty of indicators to show you why I think we are still in the beginning stages of an expansion, and that Delta was just one of those, wrenches that kind of was thrown into the spokes and kind of, had our bicycle crash a little bit. But we're about to get back on the bicycle and ride down that road and continue our expansion. But with that expansion comes price increases. So that's something that you have to take note of when you see increases in durable goods investment, when you see increases in prices for commodities that basically tells you that these manufacturers are have a lot of demand coming from wholesalers and retailers. Otherwise, those commodity prices would actually be decreasing because manufacturers are saying, well, we don't need this. So this is all just a sign, an additional sign to the bond market when you look at these value chains, that inflation is coming. And as we see gold and silver today, gold is at 1752, silver is at 2268. Yes, they are weak, but that weakness will not last for long. So guys, let me know what you think about the additional metric of looking at value chains in conjunction with the bond market to kind of, I kind of like what this one guy said, read through the tea leaves and see where we could be heading in the future. All right, guys, thanks again for watching.